As the saying goes, hindsight is 2020. The phrase is most relevant with respect to how we look at the performance and struggles of the travel and leisure industry over the past year. For most of 2020, our industry operated with limited visibility, and in many cases we were flying blind. Our forecasting acuity became very nearsighted, and even then we had blurry vision. As we look ahead, we need to adjust our point of view to gain a clear perspective on 2020 and envision a sharper rebound in 2021 and 2022. The global volume of room nights booked through the major distribution channels fell by more than 50% in 2020. From direct booking with the major brand families to online travel platforms, 2020 metrics were merely a shadow of 2019 levels. Although its room night generation was still down 41%, Airbnb moved ahead of Expedia in booking volume. Over the past year, we've become focused on weekly occupancy to gauge the improvement in fundamentals. In doing so, we've turned a blind eye to the typical seasonal demand patterns. In the second week of November, many headlines warned that the weekly occupancy had fallen to its lowest point since May. However, that statement would have been true in any prior calendar year regardless of economic conditions. Rather than looking at last week, last month, or last year, let's look simply at normal levels based on seasonality and holiday shifts. In doing so, we create a normalcy index to better assess the recovery trajectory. After the trough in April, occupancy steadily improved with spikes for major holidays. Over the course of the past few months, the normalcy index has hovered around the 70% level. With a modest boost in the spring, followed by strengthening demand over the summer, an occupancy of 53.5% is reasonably achievable for the year. With the expectation that group and meeting business would bolster performance in 2022, a return to the low to mid 60% range next year is well within our sights. All of the major brands suffered steep declines in RevPAR last year. The limited service segments and economy extended stay hotels in particular were the most resilient. RevPAR for full-service hotels all fell by more than 50% year over year. In many cases, the RevPAR of full-service brands dropped to the level achieved by their limited service counterparts. The decline in top-line performance has resulted in significant cost-cutting measures and staff reductions. Yet in most cases, these efforts have been unable to maintain positive cash flow or cover debt service. The lack of profitability in our industry has led to a sharp rise in distressed assets. The hotel CMBS delinquency rate hovered around 1.5% until last spring, and in the blink of an eye, the percentage of delinquent loans rose to the 17 to 18% range. While a plethora of money-losing assets looks like eye candy to eager investors, many owners and lenders have worked together to avert unnecessary fire sales. Stakeholders continue to assess their struggling assets to sustain operations until we reach the light at the end of the tunnel. With the global travel shutdown in mid-March, air traffic was nearly invisible in April. It has slowly rebounded to 35% of normal as of December. Naturally, domestic travel leads the way at 39% of normal, and international travelers is only 22% recovered. The recovery of air travel has not been equally dispersed across the major markets. Through December, a sampling of 12 major airports in the U.S. shows a recovery range from roughly 20% of normal levels at JFK in New York to 55% of normal at both DFW and Denver. Over the past 25 years, there has been a high correlation between air passengers and occupied room nights in the U.S. On average, for every air passenger, there were approximately 1.4 occupied room nights. In 2020, the ratio jumped to 2.2 room nights for every air passenger. While the volume of air passengers dropped 62%, room nights fell only 35.7%. Still significant, but not at the same ratio. Local and regional road travel has tempered hotel industry metrics from the full effect from the deficiency in air passengers. While restaurants and bars have been impacted due to restrictions, they have made significant strides by expanding takeout options and utilizing outdoor space to maintain revenues. After the fall-off in business in April, revenues at food services and drinking places returned to a level only 20% below normal by August. With the return of restrictions in many markets, sales dipped again in November and December. However, revenues bounced back in January to 83% of normal. With people in lockdown, spending shifted to food and beverage stores. Stores experienced an exorbitant lift 25% above normal in March as food supplies and toilet paper were stockpiled. Food and beverage store spending receded since then, but has remained around 8% above normal since June. Combining the boost in sales at grocery stores with the lower restaurant revenues adds more clarity to the food and beverage spending picture. In January, total food and beverage sales were only 3.6% below normal expectations. It's not difficult to envision a quick recovery for the restaurant industry when consumer spending within the food and beverage sector is already highly evident. It's easy to see the concerns at the top line, as these eye-popping headlines constantly flood our field of vision. However, we can't be so myopic as to only view data points within our own industry. Rather than looking away, it would be better to expand our peripheral vision to look at the bigger picture. If we shift our focus to underlying trends in the broader economy, we can't lose sight of the fact that most other industries are well along on the road to recovery, if not already in expansion mode. While current metrics provide poor optics for the hospitality industry, key pieces are in place for a strong rebound. Many of the drivers for our industry have already returned, including personal income, disposable income, savings, and corporate profits, all of which are well above fourth quarter 2019 levels. While some economists forecast unemployment to hit as high as 30% last year, we peaked at less than half that benchmark in April. Over the preceding 9 months, we witnessed the swiftest jobs recovery in history. When we look at the employment situation, the first thing to catch one's eye is the high number of jobs lost in the hospitality and leisure sector, accounting for nearly 40% of the total jobs lost over the past year. During the financial crisis, our industry only lost 623,000 jobs. At the peak of COVID, we lost over 8.2 million. More than half have returned over the past few months, but 3.9 million are still unfulfilled. If we shift to a slightly different lens and remove our sector from the unemployment data, we see noticeably different measures. In fact, if you remove the lost hospitality and leisure jobs from the unemployment calculation, the unemployment rate for January falls to 3.9%. To put that in perspective, over the past 50 years, in over 600 months, there were only 20 months where the unemployment rate was below 3.9%, and 19 of those months occurred in the 2 years prior to the COVID pandemic. While unemployment soared in the second quarter of 2020, gross domestic product dropped. GDP rebounded in the third and fourth quarters, yet sits below the prior peak achieved in the fourth quarter of 2019. However, by filtering out the leisure and hospitality contribution, GDP for the fourth quarter of 2020 would be nearly level with GDP from the fourth quarter of 2019. Once again, we're able to visualize the strength of the underlying economy, which will be critical for the hospitality industry's recovery. The catalyst for our recovery is right in front of our eyes, as defeating the pandemic reactivates our industry. The accelerated pace of vaccinations in the U.S. has already surpassed expectations. In less than 3 months, almost twice as many people have received a vaccine shot as those who tested positive for COVID over the past year. At the current rate, more than 70% of the adult population, which comprises the vast majority of travelers, will receive the vaccine by early summer, just in time for the onset of vacation season. Not everyone will see eye to eye on how the recovery for our industry will take shape. Some aspects of future travel still remain fuzzy, but there is no doubt that things are looking up. While there is no prescription for a quick fix, the resurgence in travel is probably closer than we think.